Before you buy your first investment property, you need to understand how the numbers actually work. Today, I'm going to walk you through a real example so you can decide if you're ready to move forward and what you need to prepare before you do. I've got a lot of numbers to cover to give you a true picture of what investing looks like today, but I'm going to do my best to keep this light, easy to follow, and actually useful. This is the same framework I use when I'm helping clients prepare for their first investment purchase. If you've been interested in investing but haven't made a move because the numbers feel overwhelming or unclear, this is meant to simplify the process. You don't need to be an expert, you just need a clear way to evaluate a deal and understand what you're committing to before you buy. Step 1. Before we get into the math, it's important to set realistic expectations for pricing here in the Chattanooga area. The average home sale price is around $400,000, so for an investor looking to buy and hold a property as a long-term rental, a purchase price around $300,000 is often a very realistic starting point. More commonly, for investors looking to buy and rehab, prices tend to fall in the $150,000 to $250,000 range. That range often allows for manageable renovation budgets while still leaving room for long-term value. At the very low end, around $50,000 if you're typically looking at a major renovation, which carries more risk and usually isn't the right first step for most investors. For this example, I'm going to use a $300,000 purchase price because it reflects a common long-term buy and hold scenario in this market. With a $300,000 purchase price and a 25% down payment, that means $75,000 out of pocket up front. I'm also assuming about $7,500 in closing cost, which brings your total cash invested to roughly $82,500. This is the first number I want you to feel comfortable with before moving forward. Step 2, monthly payment. Next, we look at a true monthly payment, not just the loan amount. On a $225,000 loan, using a 7% interest rate over 30 years, the principal and interest payment is about $1,497 per month. On top of that, I'm assuming about $2,000 per year in property taxes, which comes out to roughly $167 per month, and about $1,400 per year in insurance, or around $1,700 per month. When you add all of that together, the true monthly payment, what we call PITI, is about $1,780. Step 3. Next, we layer in operating expenses. I'm assuming the property rents for about $2,400 a month. If you're using property management, 10% of that, or about $250, goes toward management. I'm also budgeting roughly $150 a month for maintenance and about 5% of rent, or $120 for vacancy. Altogether, that puts operating expenses at around $510 per month. Step 4. When we combine the true monthly payment of about $1,781 with operating expenses of roughly $510, the total monthly cost to own this property comes out to about $2,291. This is your true holding costs, and it's the number I want clients to feel comfortable with before focusing on returns. Step 5. With the property renting for $2,400 per month and total monthly cost around $2,291, that leaves you with roughly $109 per month in cash flow. On an annual basis, that's about $1,300 per year. It's not huge, but it's positive. Step 6. When we look at cash on cash return, we take that annual cash flow and divide it by the total cash invested. In this example, about $1,300 divided by $82,500 gives us a return of roughly 1.5%. That tells us right away, this isn't an income first investment. I want to pause here and acknowledge something important. Higher interest rates and stronger pricing mean many solid deals are closer to break even than they were in the past. That doesn't mean the return isn't there. It just means the return shows up in different ways. When you pay attention to the annual appreciation and debt paydown, the overall return on investment can still be very strong, even when monthly cash flow is modest. Step 7. In the first year on this loan, approximately $3,300 of the balance is paid down. That's equity being built month after month, without you having to do anything extra. Step 8. Now let's talk appreciation. Using a 5% assumption on a $300,000 property, that's about $15,000 in value gained over the course of a year. Appreciation isn't guaranteed, but it plays a major role in long-term performance. When you add everything together, you have roughly $1,300 in cash flow. $3,300 in principal paydown, and $15,000 in appreciation. That gives you a total annual gain of about $19,600. When you divide that by $82,500 invested, you're looking at a total return of roughly 24%. In our market, one of the most profitable long-term moves is often buying a home that needs some renovation, so you can purchase below market value. Complete the updates, pull your cash back out, and recycle it into the next deal. The strategy takes more planning and support, and it's something I walk through with clients individually. For today, though, this video is simply about understanding the investment numbers for long-term rentals in today's market. The goal isn't to rush into a deal. It's to understand it well enough to move forward with confidence. This type of analysis helps you decide not just if a property works, but if it works for you. If you're considering investing here in the Chattanooga area and want a clear breakdown before making a decision, I'd love to talk it through with you. You don't need to have a property picked out yet. Preparation comes first. The right investment isn't about perfection, it's about clarity.